Why is deflation a central bank's worst nightmare? Once deflation sets in, it can take years for an economy to break out of its grip. Japan's lost decade lasted from 1991 through 2001, and even then its growth was slow. But what can central banks do to fight the pernicious and devastating effects of deflation? In recent years, central banks around the world have used extreme measures and innovative tools to combat deflation in their economies. Deflation is the result of vicious cycle that start with a slowdown in consumer spending, followed by business cutbacks and layoffs, leading to high unemployment, less spending, and more defaults. The Federal Reserve famous quantitative easing (QE) policy following the 2008 till 2009 financial crisis is a model strategy for combating deflation. The long-term effect, including a massive increase in public debt, are yet to be determined. The effect of deflations. Deflation is defined as a sustained and broad decline in price levels in economy over a period of time. Deflation is the opposite of inflation and is different from disinflation, which describe an economy in which the inflation rate is positive but falling. Brief periods of lower prices, as in a disinflationary environment, are not bad for the economy or for consumers. Paying less for some goods and services leaves consumers with more money left over for discretionary expenditures, which should boost the economy. In a period of declining inflation, the central bank isn't likely to be hawkish, in other words, inclined to be aggressively raise interest rate on monetary policy, which would also stimulate the economy. Deflation is different. Deflation occurs when consumers stop spending any more than necessary. As prices fall, they put off buying big ticket items in the hope that they will fall further. The trend continues and builds up speed. In the United States, consumer spending accounts for 68% of the economy, and economists consider it a reliable engine of the global economy. Imagine the negative impact if American consumers put off spending on big ticket items because they think goods may be cheaper next year. Once consumer spending begins to decelerate, it has a ripple effect on the business sector. Companies begin to defer or slash capital expenditures, spending on property, building, equipment, new projects, and investment. They may begin downsizing workforces to maintain profitability. This creates a vicious circle, with corporate layoffs imperiling consumer spending, which in turn leads to more layoffs and rising unemployment. Such a contraction in consumer and corporate spending can trigger a recession and, in the worst case scenario, a full-blown depression. Another hugely negative effect of deflation is its impact on debt. While inflation chips away at the real inflation-adjusted value of debt, deflation adds to the real debt burden. Defaults and bankruptcies by indebted households and companies rise. Recent deflation concern. Over the past quarter century, concern about deflation have spiked after big financial crises such as the Asian crisis of 1997, the tech wreck of 2000 to 2002, and the Great Recession of 2008 to 2009. The concerns were intensified by Japan's experience after its asset bubble burst in the early 1990s. Here's how it happened. To counter the Japanese yen's 50% rise in the 1980s and the resulting recession in 1986, Japan embarked on a program of monetary and fiscal stimulus. This caused a massive asset bubble as Japanese stock and urban land prices tripled in the second half of the 1980s. The bubble burst in 1990. The Nikkei index lost a third of its value within a year and kept sliding until October 2008, when the Nikkei was down 80% from its December 1989 peak. As deflation became entrenched, the Japanese economy, which had been one of the fastest growing in the world, slowed dramatically. Real GDP growth averaged only 1.1% annually beginning in 1990. Thank you.